As I have been talking about on this podcast, the specter of less loose monetary policy continues to drive the great rotation out of the momentum stocks, the overpriced stocks that enjoyed the huge benefits of the bubble are now collapsing as the Fed has effectively pricked that bubble, not by actually tightening policy, but simply by talking about tightening policy. That's all it took to prick the mother of all bubbles. But as the air is coming out, that air is flowing into the value sector of the global markets, which have been overlooked for the entirety of the move up, as people were using those stocks as a source of funds, selling value dividend-paying stocks to free up the capital in order to invest in the momentum stocks, because there was a huge opportunity cost. Even though a lot of these stocks looked cheap, nobody wanted to buy them, because if you put money into a value stock, that was money that you couldn't put into a momentum stock. And even if that value stock looked cheap and paid a good dividend, that paled in comparison to the appreciation that was being enjoyed in the speculative end of the market. Well, that greater fool theory dynamic always ends badly, and we're seeing that now as the bottom is dropping out of these stocks. The carnage this week really got started on Thursday, because Thursday morning we had a rally in the market. In fact, the Dow, I think, at its high point was up 450 points. And remember, bear markets slide a slope of hope, and you get a lot of big rallies, usually early in the morning, and those rallies engender some false confidence. People think, aha, the bottom is in, I'm glad I didn't sell. But of course, then the real move continues. Investors take advantage of higher prices to continue to unload overpriced stocks. And that's exactly what happened, because that 450-point rally turned into a better than 300-point decline by the close. That was a 2.2% reversal from the high to the close. It was even more spectacular in the NASDAQ. The reversal there was 3.2%. Now, I think one of the catalysts for the reversal, but I think it would have happened anyway, so I don't necessarily think that this is the reason, but it certainly gave investors a reason to pause. And that was news that broke about Peloton, that they were going to suspend production of their bikes, because obviously they had already produced too many during the pandemic and the demand is not there, and so they don't need to make any more. And that caused a big drop in the stock. I think it fell about 15%. And I think that caused people to worry, hey, look what's happening to Peloton. This could happen to other stocks. Demand is not what we thought, and this could apply to a lot of companies, not just Peloton. So I think other stocks were sold in sympathy. Now, Peloton actually rallied back about 11.3% Friday, so it didn't totally recover what it lost, because I think the president came out and said the rumors were false, we didn't halt production, so there was a bit of a rally on Friday. But that rally didn't help the rest of the market, which was actually reeling from the news that came out after the close on Thursday from Netflix. Now, Netflix has been one of the darlings. It was one of the key stay-at-home trades. After all, people that weren't going to work were staying at home and they were watching Netflix. And so that was a primary beneficiary of that trade. Well, after the market closed on Thursday, Netflix reported earnings. And though the earnings were better than expected, the subscriber growth was well below expectations. And that's all it took to cause the stock to immediately tank about 20% in after-hours trading. It was down as much as maybe 25% on Friday. It closed slightly off the lows, down about 22% on the day. That brought the weekly decline to 24.4%. So far this year, Netflix is down 34%. The month of January isn't even over, and we're now down 43% from last year's high, solidly into bear market territory for Netflix. And also Netflix is a victim of its own success. Look at all of the streaming services that people have to choose from. That's what happens. You become successful and then you get competition. That's why it's dangerous to bid up prices on stocks like a Tesla because, hey, they've got this great product. They're in electric vehicles. Yes, but if you're successful, other companies come in and eat away at your market share. And so investors don't get the type of dominance that they expect. And Netflix has all sorts of competition right now. In fact, earlier in the week, Netflix announced, and I mentioned this on my last podcast, an 11% price increase for their service. And one of the reasons they may be raising prices apart from inflation is because they can no longer drive earnings by picking up more subscribers because it's too competitive out there. In fact, they may be losing some subscribers to these other services, so they're trying to make it up by milking their subscribers for as much money as possible by jacking up prices. But of course, that may give some people a reason to cancel the service because there is so much to choose from. The market is getting saturated, and of course, people only have so much money. There's only so much room in your budget for these services. You can't have them all. But this is starting to weigh on the market. But let me go over the averages because these are some pretty big numbers for January. And again, remember, the January effect is very important. So goes January, so goes the year. Well, if that's the case, this is going to be one hell of a year, and not in a good way if you're long, but in a very bad way. So look at the Dow. The Dow ended up down 1.3% yesterday to finish the week down 4.6%. So far this year, the Dow is down 5.7%, and we're down 7.3% from the peak. Now, technically, we're not even in a correction territory in the Dow. We're not that far off the highs, but the reason that the Dow is holding up is because the stocks in the Dow are not nearly as speculative and momentum based as some of the stocks that are in the S&P, which is why the S&P is doing worse. Yesterday, the S&P dropped 1.9% on the day to end the week down 5.7%. So far this year, S&P is down 7.7%, and we're 8.7% from our high. But what's really weakening the S&P are the tech stocks and other momentum type stocks. Look at the NASDAQ. The NASDAQ dropped 3% on Friday. It ended the week down 7.5%, and year to date down 11.6%. 14% now from its peak. We are in correction territory in the NASDAQ. The only index doing worse is the Russell 2000. That index was down 1.8% yesterday, but down 8% on the week. Year to date, down 11.5%. And so far from its peak price last year, the Russell 2000 is down 19.2%. We are less than 1 percentage point away from a bear market in the Russell 2000, and we're not even finished with the month of January. And the Russell 2000 is not going down because of these big tech stocks. This is more a reflection of the real economy in the U.S., the domestic economy, which is weakening. I'll get to that a bit later in the podcast. Earnings also under pressure from a weakening economy. This really tells the story of what's going on, and we are almost in bear market territory. In fact, the rate at which the NASDAQ is dropping, we can be in bear market territory pretty quickly there as well. But let's focus in again on those momentum type names, the most overvalued of the NASDAQ type stocks. And the proxy for that I have been talking about on this podcast is the Cathie Wood ARK Innovation Fund. ARKK is the symbol on that. ARK was down 5.7% yesterday on Friday in one day. Remember, this is not just one stock. This is a whole portfolio of stocks down 5.7%. Supposedly you get some diversification by being in that ETF, but when you're diversified among extremely expensive, overpriced, high-risk momentum stocks, you might as well have no diversification at all, which is something that I pointed out in the past when criticizing her approach to investing. The ARKK ETF is now down 10.9% for the week. That's 1 week's decline. Year to date, it's down 24.4%. That's an entire bear market in less than a month. But it's worse if you look at how much we're down from the high price, which was a couple of months ago. It's down 55.2%. In fact, if you look at all the money that has gone into the ARK fund since inception, Cathie Wood has net lost money for her customers. So even though she became the darling of Wall Street when there was this big run up, overall, money has already been lost, even if you take into consideration the early profits, because the fund is still well up from where it was a couple of years ago, but it doesn't matter because most of the money came in when the prices were higher, because it was the good performance that sucked in all the money. And then when all the money came in, she had to take that money and buy more of the same overpriced stocks that are the reason so many people wanted to buy in. But it was a great contrarian indicator. There's still a lot of air yet to come out of that bubble. Don't make the mistake of thinking that this stock is a bargain just because it's down 50%. It's down 50% from prices that never should have existed in the first place. It's like these department stores, whenever you go into them, if you ever go into a store these days and go to the jewelry department, everything is always on sale. Why? Because everything is priced so high just so they can put it on sale to make you think you're getting a bargain. But you're not. You're actually paying full price because nobody ever pays the actual full price because there's always a sale. Well, that's what's going on here. It's 50% off based on an inflated price. You're still overpaying at 50% off. You need to buy this thing 90% off or something like that before you actually get a bargain. It needs to be on a closeout, blowout, all sales final type of deal, not just your normal 50% off.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where do you start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.